This model introduces a bit more complexity and starts to resemble business reality a bit more closely. So costs have been split into cost of sales and overheads. And we're focusing now on a retail business that has an inventory balance and has to make purchases of inventory before it can then sell that inventory on to customers. So the first step is to set initial values for the various sliders. So there are some default values which you can adjust. And the main one that we need to change is the level of purchases, because before we can sell anything, we're going to have some inventory in stock. Before we click Start, we can note that the financial statements on the right-hand side now include all these additional elements, and again, these will update automatically as the simulation is run. At the bottom, we can see the key bits of financial information: revenue, gross profit, operating profit, and net cash flow. So we click Start, we start to see receivables balance staying fairly constant because customers are paying after 2 days. Net cash flow is £50,000, revenue also £50,000, and this is because we haven't yet started to pay suppliers. So this business is now steadily building up inventory. Its receivables and payables balances are constant, and it is generating profit. But note that its net cash flow is 0, and we can see that due to the fundamental accounting equation, if these balances are constant, if this one is constant, if this one's going up, this one must be going down. So that's exactly what's happening here. The business is generating a profit, but it's not generating more cash because it's buying more inventory than it needs. So this model can be used to explore the operating cycle, looking at how long business is keeping its inventory in stock for, looking at how long it's taking for its customers to pay, and how much credit it has with its suppliers. It can also be used to look at paying dividends. So to pay a dividend, drag this slider along. So we're going to pay a dividend of £200,000, and we can see that that reduces the amount of profit that still needs to be distributed to shareholders, and obviously reduces the amount of money in the bank account. And the model can also be used to explore working capital management. So in this scenario, for example, this business has built up far too large an inventory balance, so even though it's been profitable, it's got no money available to actually pay dividends. Alternatively, this business has its receivables balance that is much too large due to offering customers too much credit. So again, even though it's profitable, it can't pay dividends. So there's quite a lot to explore using this model, but it's a really powerful way of visualizing the operating cycle.